One-sided foreign currency denominated linked loan, kind of a strange name, but what happened here is basically the following. Here's the background. It comes actually from a lawyer coming to me and asking for some help. Okay, I was approached by an attorney who asked for advice in analyzing a rather complex issue of one of the clients. And basically what the story was as follows. That customer took a loan from a bank, a mortgage loan, a long-term mortgage loan. It was 15 or 20-year mortgage. This was in Israel, and in Israel at the time it was very customary for loans like this to be linked to a foreign currency. In this case, linked to a dollar. In other words, the calculation was as follows. Here's the loan, let's say it's $100,000 loan, mortgage loan. The bank would compute how much the person has to pay in dollar terms every month, using the straightforward coefficients. And then every month you pay according to the exchange rate, to the official exchange rate or the time that is quoted by the central bank, you pay accordingly. So when the dollar goes up, the price of the dollar goes up, you pay more. The dollar price goes down, you pay a little less. Each month it is adjusted. So that was the very customary in Israel. The problem that this person had and approached the lawyer is as follows. The person received the loan when the exchange rate was about 4.5 Israeli shekels to the dollar. Israeli shekel is the Israeli currency, 4.5, 4.50. When he approached the bank, or not the bank, the lawyer, the exchange rate was about 3.80. And so the lawyer said, so why do you complain? Okay, so now you are paying actually less in terms of your Israeli shekel, so you have to be happy. No, the person said, the bank actually tricked me in the following sense. It was this one, as I said before, a one-sided linkage. In other words, the contract was as following. I write here, it was a 15-year loan, fully linked to the US dollar, both principal and monthly interest. At the time, the rate of interest on the loan was 4.5% annually, so much per month. And I give here kind of a numerical example. I do not want to actually go very detailed, but here's the story. I'll just jump here into the trap, okay? Before signing the mortgage loan agreement, the bank inserted another paragraph to the agreement. The bank insisted that the linkage to the exchange rate will be one-sided. In other words, more specifically, the paragraph stated that if the exchange rate in any given month is higher than the basic rate, the rate that was in effect when the contract was signed, then the monthly payment will be determined in accordance with the formula 1 above, which means higher price of the dollar, you pay more. Otherwise, the payment will be the original amount. In other words, it was kind of a situation where the bank said, we flip a coin, if it falls head, I win, and if it falls tail, I do not lose. In other words, if the exchange rate goes up, you pay more. If the exchange rate goes down, the price goes down, you do not pay less. You pay according to the base rate, which was stated in the contract initially. Okay, here, simply stated, here's the formula. Okay, in our case, in the numerical example, you have basically the following. If in the payment in month T, if the exchange rate at the time will be greater than the base rate, in other words, the price of the dollar will be higher, you pay more. But if it will be less, you do not pay less, you pay according to the base rate. The lender is therefore protected against the rise in the price of the US dollar and does not suffer if the price goes down. Such a loan is a one-sided linkage of the monthly payment to the exchange rate, and basically we have here a problem. The person comes and said, well, it's unfair. In retrospect, it was unfair because now the exchange rate is much less and I'm still paying according to the base rate, which I find kind of impossible. The lawyer asked me to provide some kind of a help or an explanation as to what this situation is, and I started to think about it, and it turns out, of course, that you can actually form this or formulate this arrangement as follows. One, It's a regular dollar-linked mortgage loan, but in addition, and this is the thing that is kind of surprising, the borrower is actually providing the bank with options. Options to sell US dollars at a predetermined rate. Very strange. Okay, you're a customer, you ask for a loan from the bank says, okay, here it is. And before you know, you, the borrower, you are giving the bank options. And how many options? Well, if the loan is a 15-year loan, what happened here is that you are actually giving the bank right now 180 put options. Options to sell to you US dollars, a certain amount of US dollars at a given rate. Why 180? Because you have over 15 years, you have 180 months. Payments are 180 payments. The first option is 1 month. The second option is a 2-month option. The third one is a 3-month option, etc., all the way to 180-month options. Okay, these are put options, that is options to sell to you at a certain number of dollars per, shekels per dollar. In other words, and the rate is, of course, the base rate. Very strange. You have here a certain situation whereby the borrower, a person or a family that receives a loan from the bank, is providing the bank, without really knowing, without understanding, 180 options. Each of them has a value. And by the way, the longer or the further it is from the present, the more valuable this option is. A very, very complex situation. And so the lawyer asked me, well, first of all, it took me a lot of time to explain to this lawyer what the situation is all about. And then he said, well, can you give me some kind of an estimate of what this value is? Now here I used a model that a colleague of mine and myself developed way back in the early 1980s. Actually, the first paper published on the pricing of foreign currency loan or foreign currency options is a paper by John Hull and myself, 1982. So I used this model and tried to put some reasonable numbers for the assessment of the value. And the paper has a detailed, detailed table, which I'll show you very quickly. You'll, of course, be able to read all the numbers in this table in a second. By the way, that's the model here. The two formulas up there, which were developed by John Hull and myself. Okay, Biger Hull, European currency options. And, sorry. This table is a demonstration of what you should not do in a presentation in a conference. Okay, because somebody here will ask me, okay, just a moment. What is the number in row number 27? Do you guys read it? Can you read it? Of course not. Okay, so don't do it in the presentation. But basically what happened here is as follows. I tried to compute the value of all of these options. There's 180 options. The sum of these options turned out to be something like 10.5% of the value of the loan, of the dollar value of the loan. In other words, to put things in perspective, if the loan was 100,000 US dollars, the borrower who received the loan and agreed to that time of the term, okay, this one-sided linkage to the dollar value, actually gave the bank, at the moment the contract was signed, of a $100,000 loan, $10,000 or about $10,000 back immediately. In other words, the effective loan was not 100,000, but only 90,000, okay? Without the borrower knowing, without the borrower understanding what was going on. Now here is the situation where it becomes kind of tricky. It is very difficult to assess the value of these options because it does involve a certain set of assumptions, etc., etc. I will not go into this. If anybody can do any kind of an estimate of what the value of these options are, is the bank. Because the bank does have an economic department, these people know options, they know how to compute, they have all the mathematicians that help them do all of these computations, etc., etc. So the bank can find out more or less what is the value of these options. An individual who borrows from the bank, a family that takes a mortgage loan, have no idea whatsoever, not only of the fact that they are giving 180 loans, 180 options, not to mention how to estimate the value. What is it that they are giving? So it's a very unfair game, okay, between a powerful bank and I won't say poor necessarily, but a person who cannot really evaluate the value of these loans or the value of these options that he or she are providing the bank without actually knowing. We did a full analysis. It was presented to a court, and the judge asked me, so what are the implications? The response was that actually the monthly payment that person was paying every month, okay, should, to start with, have been 10% less. In other words, every time the person made a payment, that person should only make 90% of that payment, because the person actually received only 90% of the initial loan by providing the bank with a set of options whose value was about 10% of the total value. So this is the interpretation, and I think that basically what we have here is a paper that I think you should all be very interested in to read. So thank you very much.